According to the Excellence in Risk Management survey, there remains a gap between risk managers and senior leaders on the role of risk management, whether it should be primarily defensive or be more anticipatory. More than 1,300 risk managers from some 50 countries responded to the survey. Most risk managers and senior executives agree that expectations of the risk management function have increased in recent years. While C-suite executives expect risk managers to be more involved in strategic planning and to lead ERM activities, risk managers think their priorities are more related to operational issues. I spoke with Brian Elowe from Marsh's Global Risk Management Division and Noel Seaman from the University of Saskatchewan about the report they presented at RIMS in Philadelphia.
Well, I think this year's survey really focused on what the gap is between what the C-suite's expectations are of risk managers and where risk managers add value to their organizations. And I think the most surprising thing for me, which is really good news for most risk managers, is that the C-suite really recognizes the inherent skills and capabilities of risk management. And what they're really asking for is move into the gap, move into the fray, get involved more broadly with respect to the strategic opportunities of the organization. So what was surprising to me isn't so much the general findings that there's a bit of a gap, but I was pleased to see that there's a good alignment in terms of wanting to strengthen the use of what risk managers can provide.
The traditional risk manager focused a lot on operational risk and insurable risk, and perhaps the answers could be reflective that there is still a lot of risk managers where that's the focus. There are certainly many risk managers that are focusing on strategic risks as well. As Brian said, I think there's a real opportunity for risk managers to move up and apply what they know about the process and about the organization to help the organization explicitly deal with the risks around their strategy, planning, and execution.
Well, I think we've seen a continued moving towards analytics driving decision-making frameworks for organizations. During the financial crisis, a lot of models were called into question in terms of what their value was to organizations. And enterprise risk has been going on for some time in identifying risks within organizations. I think what you're seeing now is a move towards really understanding what are the insights that data can bring to us as an organization, and how do we marry up the quantitative and the qualitative components of risk in our organization. So an example of that is many organizations still don't have a view on what their risk tolerance is. And risk tolerance really grows out of both a quantitative analysis as well as a cultural discussion about how certain organizations view risk and whether they have a high acceptance or a low acceptance of it. And so understanding that, and then understanding the downstream decisions that risk management makes around risk finance and other methodologies, really what it does is it shows that the organizations need to marry up analytics more thoughtfully with respect to what their decisions are downstream, and I think that that's what you're seeing as a move towards that.
I would think it suggests that there has been a lot of work on the implementation of enterprise risk management in organizations. Indeed, it seems to show that if you haven't implemented an enterprise risk management system, or by any other name, an integrated risk management system in your organization, you're probably not in the majority, you're probably lagging behind. People are happy that they've implemented ERM and that it's working, and so there's perhaps less urgency.
Well, I think a couple things. First of all, most of the global catastrophic events you hear about these days affect most organizations because they are global. So whether it's directly because their operations were affected, or because some of their suppliers or people they supply to were affected, and we saw a lot of supply chain systemic risks really come out of that particular event in Japan. And as a result of that, it has moved organizations faster towards the need to understand from a quantitative standpoint, where are they actually exposed, even if they don't have operations in certain countries. And so I think what you're seeing is a drive towards really understanding supply chains more deeply, and how those supply chains connect to organizations, even if it isn't your own supply chain that's actually directly affected.
There's a lot of profile in the media when there is a cyber attack. Organizations realize that it's more than just a cyber attack. It's your reputation at stake, your ability to safeguard information, as well as the operability of your systems. So I think there's a critical infrastructure element to that, as well as the safeguarding of data data, which is critical to your reputation. But clearly, systemic financial failure is a very significant risk that affects us all. Perhaps cyber attack is perceived as being more imminent, but systemic financial failure certainly would have a catastrophic effect on organizations. We see severe weather catastrophe becoming one of the greatest risks in insurance faces. It starts to become very important. People start to discuss it.
Well, I think there's a couple things that organizations are looking at. One is that World Economic Forum report that you referenced, and the stratification of risks and how they affect organizations, how they manifest themselves in organizations. And I think if risk managers are using that as a backdrop for strategic discussions, then it raises up good discussion within those organizations. And that was one of the insights that we brought forward in the report this year. I think the other thing people are looking at, certainly very closely is we're in a transitional insurance market. The markets are definitely under some pressure from a profitability standpoint. We're seeing some movement in certain areas, and I think that as those movements become more prevalent, risk managers and brokers and others are going to be looking at how does risk finance efficiency actually look, and how does the cost of insurance capital compare against the use of own corporate capital. And I think you'll see a lot more work going on in that world over the next 12 months.